You're listening to Indications by the Conference Board.
Hi, welcome to Indications. I'm Jonathan Liu, and I'm joined with Lynn Franco, our Senior Director of Economic Indicators here at the Conference Board. Hi, Lynn.
Hi, Jonathan.
Hi. So it's the last Tuesday of the month, and that means our topic today is consumer confidence in the U.S. What did the report in February show, Lynn?
Well, we had a slight increase. Confidence went from 130.4 in January to 130.7 in February. A little bit of underlying changes, however, in both the present situation and the expectations.
And so just taking a look at those indices, the present situation fell 8.8 points. The expectations index was up 6.4. Now, is that divergence a sign of anything in particular, or is it just something that comes out in the churn of the data from month to month?
It could be a little bit of noise. We'll continue to monitor what happens in terms of the present situation index to see whether or not there's a sort of continued weakness there. Right now, a reading of 165.1 is extremely strong reading, so it tells us that consumers are still very confident in current economic conditions. In terms of their expectations, that went up, so they do expect the expansion to continue over the next couple of months. So overall, relatively good news.
Now, the one thing we should note is that most of these surveys were completed before news of the coronavirus outbreak in China, perhaps spreading worldwide, entering South Korea, Italy. And just before we started recording, the CDC came out and said that it's likely to be some clusters of spreading of the disease in the U.S. Was any of that in the data, or is that something we should look for next month in terms of the virus outbreak?
It didn't sort of percolate to the top of concerns among consumers. We have a separate question where they write in their responses. And a few did write in the coronavirus, but it's not really right now impacting consumer confidence. It's still early days, so I think we need to see this, play out a little bit more. As you just mentioned, though, it's now sort of, spread beyond the borders of China, so it could have implications both in terms of other economies. In terms of consumer spending, we haven't quite seen that yet, and it could be that we could have a decline in confidence, but not a decline in spending, so it'll be somewhat of a muted impact.
Yeah, I think one sign of some impact perhaps is in the question on whether the respondent intended to take a vacation within the next 6 months, and that number fell from 63.3% to 52.9%. And it seems like that covers both destinations within the U.S. and foreign countries as well. Could that be an early sign of, some concern and sensitivity to travel?
It could be. It could be that people are sort of postponing their plans. I mean, this generally is around the time that one sort of begins thinking and planning about, one's summer vacation. We'll see, in the next 2 months how that plays out, because it was both for the U.S. and for foreign travel as well. Another area where I think we should keep an eye on is maybe what happens in terms of auto purchases. There's some discussion that there could be, shortages in parts. Right now, it looks like consumers are still intent on buying autos, but we'll begin to see if there's sort of any implications for this industry as well.
Right. And what about the stock market? I think by the time this comes out, we could see a rebound, but we did have 2 straight weeks of pretty heavy losses in the stocks in the U.S. Is that something that how would something like that be reflected in consumer confidence data?
I think it all really depends on the duration now. Are we going to have a bounce back? Are we going to continue on this downward trend? While point-wise, they're very large declines, percentage-wise, it's, let's say, not as drastic as we saw, let's say, for instance, back in 87. But again, if we sort of see a continued pattern, that's going to obviously impact the more affluent consumers. And so we'll continue to watch that along with what happens with the coronavirus. But at least for the time being, it seems that job growth is supporting consumer confidence and consumer spending, and we don't see much weakening in that area.
Yeah, so let's move on to jobs. Overall, it seems like there was a slight downtick in February. Just go through the numbers here. consumers' assessment of the job market moderated. Those saying jobs are plentiful decreased from about 47% to about 44.6%, while those saying jobs are hard to get increased from 11.9% to 14.8%. So there was some deterioration, but those are still really strong numbers, right, Lynn?
Absolutely. Could reflect a little bit of softening in the labor market. Given how tight conditions are, it's not surprising that more people are saying jobs are hard to get, but these are historically low figures in terms of hard to get, strong figures in terms of job plentiful. So it really just signals that the labor market remains strong. And we know really that's the key to consumer confidence. So even with a little bit of softening, it's still enough, I think, to support these high levels of confidence that we're seeing.
And what about wages? We have in February, about 22% of people expect their income to increase in the next 6 months. About 71% expect their income to stay the same, and then just 6.7% expect their income to decrease. Is that relatively as strong as the numbers we're seeing on the job market?
Yes, it's extremely favorable readings in terms of income. And we've seen, in terms of wage growth, that, the tight labor market has actually helped with wage increases. And we continue to see that. Obviously, it's more pronounced in the blue-collar field, really, where it's been harder to find people to fill jobs, and less so maybe in the white-collar. But I think there's just been an overall increase in wages that's really sort of helped consumers, both in terms of their expectations and in terms of their spending.
That's an actual question that I would have. Is there a general rule in terms of, when wage growth goes, mostly to blue collar or lower wage workers compared to when it's concentrated in higher wage workers? Does that change the consumption pattern? Is there, would you expect that to be reflected in the confidence readings at all? Like just in terms of, overall wage growth, but where it's concentrated?
It could be that if it's more concentrated in the blue-collar work, it doesn't necessarily translate into greater spending in the luxury market. But we've still seen, pretty much widespread wage gains. We've also seen exceptionally high financial asset values in terms of the stock market, which has helped then, sort of that segment of the economy as well. So I think we have a variety of facets here between, a strong stock market, irrespective of what's happened over the last few days, but also strong wage growth and a variety of factors that are just helping to boost consumer confidence and consumer spending.
And, barring any real pandemic effects, how long can we stay at this elevated level? Seems like we've been kind of just cruising along for the last year or more.
Well, we've had similar periods over time where we can cruise along at sort of these high altitudes, for years. So I think the key here is, what happens in terms of the labor market. So as long as that remains strong, it should sustain confidence. I think we keep an eye on what happens in terms of the present situation to see if there's continued weakening there, which could signal further softening in the economy. And then there's sort of these unknowns, right? So we need to keep an eye on what happens in terms of the coronavirus, how widespread that becomes, the impact on, value chains and supply chains. So we could see some softening in global economic growth, at least in the first quarter, and, perhaps a bounce back in the second quarter. But I think everything is still kind of fluid at the moment. So it all bears watching in the weeks and months ahead.
And one last thing to follow up on the conversation that we began last month on our podcast on consumer confidence. It is a presidential election year, and can you remind our listeners of the of the two ways in which consumer confidence has been used to predict the winner of presidential elections?
Well, we've had sort of a midterm reading, so if you go back in 2 years or so, it would say that would signal a change in administration. Current readings, we have to wait until we get to September, would say that, the current administration would be reelected. I think there's a lot here that's sort of still a little bit fluid and remains to be seen, but I think overall it does bode well for the current administration.
I like the idea of everything just being settled 2 years ago, and so all the commotion now is just won't change the outcome in the end.
Well, we have seen, times where consumers the popular vote has gone one way and the electoral vote has gone the other. So they're not exactly perfect at predicting. So we'll see as we get a little closer into, late summer, early fall where we are. And then we can sort of revisit what the next set of predictions will be.
Thanks, Lynn. We'll follow. We'll see. We'll speak again next month on consumer confidence, and we'll see, where this coronavirus outbreak goes, whether it's actually, a flash in the pan, or if it actually becomes serious. And we'll continue following the election trends and any other news that comes up. But right now, it looks like the consumer is doing well and is really buoying the U.S. economy, right?
Yes, they continue to support growth, and we expect that for the next couple of months. So we'll revisit it next month and see if the story has changed.
Great. Thanks, everyone. Happy shopping.
This has been Indications from the Conference Board.